Okay? Yes?
Yeah, that was really my question. A buying company, if you have, 20 customers that include Siemens and Bosch and Johnson Controls versus 100 customers that you've never heard of, smaller customers, which is more valuable?
Okay, so this is an interesting question because I have two different answers for you. Does the group follow what the question is? I'm buying a customer or a company and they have all the big name customers, okay? Or I'm buying a company that they have 100 of no-name companies. The question is, how are my receivables on those big companies? They may be better or not. You could be with Siemens, they take 2% and pay you in 150 days. So now you have to have 6 months of cash flow to handle a Siemens order. So I would look further than just the name. Look at their paying history. See what they pay. If I have 100 customers and I have 23 days of receivables, my days are 23 days, I'm getting paid fast by every one of them. If my Siemens guys are paying me in 120, I've had to float 120. So not only the name, but what that quality translates into cash is important. But, yeah.
Like how tight is the relationship? Like, do you have walls built around them that they're not going to go anywhere? You know what I mean?
Like gatekeepers and bid process. And, yes. It is. You get 40 new ones?
Yeah.
Okay.
And we grow on that, but so I think it depends on the industry a lot.
It does depend on the industry, but most people would say the company with the Siemens and the Westinghouses and so forth is way better than the guy that's 100 no-namers, and I'm not saying that that's correct. It could be, but I would want to dig a little bit further into the analysis than just the name.
Okay.
Does that make sense?
Yes.
Why didn't you talk about margin on that?
Same thing. That's part of that analysis, and I appreciate you bringing it up because that's another thing I'd look at. If I get Siemens gives me a gross margin of 43% and the 100 give me 55%, another metric to look at besides payable time, but what's my margin with them? So it's not an answer that just because they have a big name, that may or may not be better. You need to look into margin, receivables, repeat business, right? All that stuff. So it's not as simple as, yeah, you have big names, great.
Once they get the software, they can't get out without going out and buying a new software, which would be a high cost of changing.
But this is also be a fun issue, opportunity processing as the group, is say, here's a company that has these, here's a company that has that. Have the group help you analyze which one is the better deal. It'd be kind of fun. Yeah. It'd be a fun issue, opportunity processing. Okay, add-ons. You good that we use future. It's very important. We use synergies, by the way. We want to look at the synergies. We don't do that unless you give us the synergies. You'd have to give us the numbers. But we can tell you the difference of the value between with and without synergies, right? And so, in my mind, the future is just as important as the past. What else did you have? And we talked about the add-ons. Was there something else in your question that I didn't answer?
My understanding of what you explained is that where you sit on the curve, on which curve, is negotiation.
Correct.
As long as you've got the parameter.
You want the numbers so that you can negotiate your strengths. Good? Okay. Okay, now, I think our brothers back here wanted to know about the role of investment banker, right? So, you can sell a business independently, and the time that it'll take you to sell it is about 70% of the CEO's time, between 50 and 70%. When you're trying to raise money or sell a business, it takes a boatload of the person's time. So what's the value of an investment banker? An investment banker will come in and charge you $10,000 to $25,000 to put a package together, and then they have contacts who they market the package to, okay? If you have a boatload of contacts already, then I'm not sure you need an investment banker. If you don't have any contacts, then you might. Now, how do you go about getting contacts? So I'm going to go into how and when to sell. All right, so what you want to do is 3 to 5 years ahead of time, you want to start preparing to sell your business. Okay? So you want to start doing the things we talked about to increase your operation, increase your margin, increase your cash flow, increase your revenue, and so forth. Now, has anybody used a press release in here? How much did it cost you? Yours was $0? Yeah, it's between $200 and say $600. You can run it out to API network, right? So have any of you had a really good year? Or brought on a big new customer or new products? Press releases, okay? You can start sending out press releases. They're very cheap. You know, they're $200 to $600. You start sending out press releases. That's starting to get some idea in the community of, hey, well, I heard about XYZ in Orlando, and wow, they're doing pretty good. Okay? Now, how many have looked at your suppliers or your customers as potential buyers? Those are prime time synergistic buyers, either your customers or your suppliers, right? So you can start, remember that proactive thing that we're going to do? Well, you can start building a proactive relationship with maybe your top 5 potential acquisition clients. Those are going to buy you. So start building a relationship with them, talking with them, learning about their business, helping them to know about your business. So 3 to 5 years out, you want to start cultivating your potential buyers. Press releases, who are my suppliers, who are my customers. Now, obviously, private equity people are out there. If you do it, how many have been called by a private equity firm? By the way, I was on the ACG board, which is Association for Capital Growth, and we had a summit that we brought out into Utah. We bring 20 to 35 private equity firms in. In 2008, before the crash, their portfolio, they were buying at between 6 and 10x. That's what they were buying into their portfolio. At 2010, what do you suppose they were selling at? 3 to 4x. That took 4,000 private equity firms down to 2,000. That number, by the way, is now over 3,000, and there's, I think, $25 billion sitting out there to invest. So if you have an EBITDA of greater than $500,000 to about $5 million, you're a target. So private equity firms, how do they work? They'll come in. They're a financial model, so you're not going to get the synergies with a strategic buyer. They're going to come strictly in for financials. But if you have systems, they're looking at growing it for 3 to 5 year exit. They'll come in and buy 60 to 80% of your company, keep you on for 3 to 5 years, and you get a double exit. So they'll bring in money, buy 60 to 80% of you, leave you on, you get a double exit. Private equity firms are great, but they're strictly financially motivated. They want a 5 to 10x in 3 to 5 years. Are we good? I'm just checking. Okay, so private equity exits are pretty good. And there's plenty of money, and there's plenty of opportunity. In fact, I have 2 right now that are worth $30 billion that are looking for companies right now.
Do you see them ruin operations a lot of times then?
Ask Vistage. Oh, Vistage, Florida, it hasn't been bought. We've been bought by 2 private equity firms. If you want to really know my opinion, huh?
I've seen it more where they come in, they buy you, buy a percentage, you stay on, you leave when your time's up because the exit hasn't occurred.
Yes.
They run the company into the ground, and then you can go back and buy your company back for a discount and get all your old customers back.
Actually, I know of numbers of Vistage members that have done that.
Yeah.
And they've bought their company back for 10 cents on the dollar of what the company paid the first time. That doesn't always happen, but it's an opportunity for you to exit 3 times.